One big, beautiful bill, and that is, in fact, its official legislative name. Now, the law of the land. What's in it for you? What's the impact on your money? It certainly covers a lot of things, right? It's 900 pages, so a lot of stuff in there. At its core, though, the primary purpose is to retain the lower income tax rates that were incorporated in the 2017 tax bill. Okay? Remember, all of those tax rates in that 2017 tax bill were set to expire at the end of the year. So unless the current administration and current Congress did something, such as this bill, they would have effectively presided over what would have been perhaps one of the largest tax increases in decades had this bill not gotten done. But it did get done, and it certainly did have a lot in there. But we want to caution you a little bit as we continue our analysis of this bill. The vast majority of this piece of legislation, and certainly the cost and certainly the impact, is to really continue current policy. Okay? Now, a bunch of headlines getting talked about this conversation about reducing tax on Social Security, no tax on overtime, being able to write off car interest, stuff like that. But that's kind of marginal stuff when you really actually kind of look at it. It's not an excessively meaningful or an excessive economic impact. The real economic impact was continuing that 2017 tax rates so that there wouldn't be a negative economic impact had all of those rates gone up pretty dramatically. And that's the real, that's at the end of the day, that's the real impact of this bill, is to prevent that potential economic drag. I mean, that's where a lot of the focus and a lot of the cost of this bill was. So at the end of the day, because of it, it really did have limited ability to introduce incredibly broad and newer tax cuts along the way. So its impact, in our view, somewhat limited in terms of its ability to accelerate things economically. Yes, it certainly prevented things from potentially slowing down economically by making permanent the tax rates, but there's not necessarily anything new. I mean, basically, these are the tax rates that you've had since 2018. They're just continuing them and effectively making it permanent. So the rates of 10, 12, 22, 24, 32, 35, 37% income tax rates that were set now stand, and they stand permanently. And obviously that's significant when you think about the 12% used to be 15, the 22 used to be 25. And now these rates don't have a sunset. They are, in fact, permanent, which, I guess as permanent as things can be in Washington, right? The reality is that if they do change in the future, then the political party that does change them will, in fact, be tagged with raising taxes. Now, but we've certainly seen history where tax rates have kind of ebbed and flowed. Right now, they're obviously ebbed at a very, very low point, which, I guess explains why the deficit is at a really, really high point. That's probably an issue for another day. Clearly, it didn't seem to really bother a lot of people in Washington, so we will carry on in that respect. Clearly, the lower tax rates are a major impact on your finances, but the point is that since these are the same rates that you've been experiencing for the past several years, then the impact or the immediate impact or the change in your personal finances is not that material. Now, it clearly presents some opportunities of things like accelerating income in the current or next few years, because while permanent, all it takes is legislative change to change these tax rates. So things like distribution of inherited retirement accounts or maybe Roth conversions might be more in the mix. as they have been for the past few years as a result of kind of these lower tax rates. The range of income for a married couple that gets you 24% is from about $100,000 to $400,000 of total income. So it's a pretty wide range. Beyond the tax rates that were made permanent and continued, what also was retained was a shift away from itemized deductions, this courtesy of the nearly doubling of the standard deduction and the elimination of personal exemptions. If you think back prior to 2018, there was personal exemptions and standard deductions, all of those combined in together to create a deduction that you could take off of your income. With the elimination of personal exemptions and a much higher standard deduction, then that is what most people find themselves taking advantage of when it comes to their taxes. So in particular, a bunch of the itemized deductions, such as unreimbursed employee expenses, casualty losses, those kinds of things, it's now permanent that they are permanently eliminated from the ability to itemize and write those specific items off. So what it basically means is that the return of itemizing your deductions certainly is not returning anytime soon. And now with the much larger standard deduction, that basically is the threshold, right? Here's how it works: you either itemize your deduction or you take the baseline amount, which is the standard deduction. If the standard deduction is so high, then fewer and fewer people are winding up itemizing out their deductions. More and more just kind of stake the standard amount because it's a much higher number, and the stats bear that out. Prior to these tax changes, something like a third of all taxpayers were itemizing their deductions. Now it is less than 10%. So you can see where that made a big difference. So the standard deduction for the year 2025 is going to be $15,750 for individuals, $31,500 for couples, and obviously will rise with inflation after that. As we said, the personal exemption of various miscellaneous itemized deductions remain gone. Now, beyond that, beyond the tax rates, beyond the standard deduction, the bill also makes permanent the increase of the $2,000 tax credit. Previously, that was $1,000. Now it's locked in at $2,000. Here, the new bill actually does do a little bit of a change because now that child tax credit is going to be automatically indexed for inflation, and the new base amount is $2,200, not $2,000. So extra $200 right there out of the gate. That's new, but it's $200, so it's not exactly going to be a big difference in people's pocketbook. As for the estate taxes, the new bill adds some clarity here, again preventing what would be a major shift if nothing was done. Remember, estate tax exemption, that's the amount that you can pass, whether you're living or whether you die, to other people and not have to worry about paying any kind of estate taxes. When I started out in this business, that number was $600,000. So really, really low, or really just an indication of how long I've been doing this. In contrast, for the current year, 2025, the exemption increased to about $14 million per person. But again, and you should be hearing a theme here, lots of things expiring at the end of the year, which obviously this bill addressed. That 14 million number would have dropped down to 7 million per person in 2026. The reality is that the new legislation sets the amount at a permanent number of 15 million per person starting in 2026, and then regular inflation adjustments after that. So other changes more or less maintain the status quo. The alternative minimum tax doesn't revert back. It stays where it is. The 20% qualified business income deduction for pass-through still exists. Again, those were set to expire. Guess what? They're not. But there are some things where were some little bit of tweaks, a little bit of changes. So we're going to have some additional thoughts on this after the break here on Dollars and Cents with Joel Garris of Nelson Financial Planning.